to session 2. In this session, we will be speaking about the basics of multi-timeframe analysis, and we will be introducing the way in which we use the Fibonacci tool. We won't be speaking about patterns yet, that is for the next episodes, but we will be introducing how you're supposed to read market structure and price action, and how multi-timeframe analysis works. Now, starting here from this basic concept. Here we have a monthly candle. Here we have this monthly candle, but broken down in basically weekly candles. So you have the same price action, but the weekly candles will show you the same price action in different time intervals. Obviously, on the monthly time frame, you will see it start here and end here, but on the weekly, you will have oscillations inside of it. This will be even more clear as you move down on the daily time frame, because on the daily, you obviously have these waves in a much more precise way. Now, what you're supposed to do when you're making your full analysis, you're supposed to use patterns and everything that I will teach you to understand the direction of the market. And then what you will do is drop down on lower time frames to take advantage of these retracements, because as a swing trader, what you want to do, you want to be able to buy with a good risk to reward ratio or sell with a good risk to reward ratio. So you need either a way to short from here or a way to buy from here, basically. And that is exactly what we will learn to do in this course. But at the moment, it's very important that you understand this. The market moves in the same way, but if you use multi-timeframe analysis, you will have more information. You will basically have the bigger picture of how the market is moving, because if you are able to look at all of these time frames for direction, because I took these 3 time frames for a very specific reason. The monthly, weekly, and daily time frames are the time frames you're supposed to use to take the direction in the market. These time frames will give you the direction in the market. The 4-hour time frame on the other side is the time frame that we will learn how to use to take entries. So this is a very important concept. Monthly, weekly, and daily, we use them for direction. On the 4 hours, we just take an entry. Let's give immediately an example that will clarify this concept here with this picture in front of us basically. We know, because we have patterns and we have many things, that the market is supposed to make this green candle. It's supposed to print this green candle. So on the weekly time frame, basically, we know that after this red candle, basically the next candle is supposed to push to the upside from a pattern perspective, because we know from the monthly time frame that the market is supposed to keep pushing to the upside. So here in the daily time frame, we will know that this is just a retracement. And what we will do, obviously, we will jump down on the 4-hour time frame around this area to understand when the momentum is shifting to our advantage, and at that point we will take our long for this push to the upside. Then again, the market will make a retracement, but we know from the monthly that the market is supposed to keep pushing to the upside. So again, we will jump on lower time frames to take our entry, because we know what the pattern is from the monthly time frame. Now, if we have, for example, a weekly pattern instead of a monthly pattern, then what you will do, the same exact thing. You will go on the daily time frame, and every time that you get the retracement, you will be ready to long the pair on the 4-hour time frame. This is exactly what you will do. So this is just to clarify the concept. The market, yes, on the monthly we know that the market is supposed to make this push, or on the weekly we know that the market is supposed to make this push. We will wait for the retracements to be ready and take our trades with our different strategies that will be taught in the next sessions. The only thing I really want you to take from this is that the market loves to move in waves, and these waves become clearer and clearer if you go down on shorter time frames. So starting from the big time frames, so monthly, weekly, and daily, and the 4-hour is just for entry. This was just to clarify this concept. Now let's speak about Fibonacci and how we're supposed to use it. But first, one last thing I want to clarify for you, because this must be clear. Now, I hope you already know this, but anyway, I will repeat it. A market that is in an uptrend is making higher highs and higher lows. So for example, the market makes a high, makes a higher low, makes a higher high, makes a higher low, makes a higher high, makes a higher low, makes a higher high, a higher low, and a higher high. And this is the exact definition of a market that is in an uptrend. On the other side, a market that is in a downtrend is making the exact opposite thing. So it's basically creating a series of lows, lower highs, lows, lower highs, lower lows, lower highs, lower lows, and lower highs by definition. This is a very basic concept, but I just wanted to share it if maybe someone is just approaching the market and is very new to it. Now, this is important. Why? Because if, for example, the market starts here and you see the market create this high, then you immediately know that the market is in a confirmed uptrend on the daily time frame, because the market has created a higher high, and after a higher high you're expecting a higher low, and after a higher low you're expecting a higher high, because the market is breaking structure to the upside. So this is a concept that I wanted to share. Let's go on the chart basically, and I want to show you how you're supposed to set up your Fibonacci and how do we use our Fibonacci now in our strategies that we will be teaching in the next sessions. So the first thing, how you're supposed to set up your tool. Very simple. This is how you're supposed to set up your tool. You take your Fibonacci as it is, the standard in TradingView, you double click on it and you go on style. Now on style, these are the only Fibonacci levels that you need: the 382, the 0.382, the 0.618, the minus 0.272, the 0.5, 0.6786, and minus 0.618. These are the only Fibonacci's that you need. The reason for which the 0.618 and the minus 272 are red, I will explain it just now. Basically, the 0.618 is the golden ratio, and it's where the market pullbacks most of the times, and the minus 272 is the first target if we take the Fibonacci in the way that I'm just about to show you. So this will be also clear very soon. So going to our Fibonacci, how you're supposed to use it. Now, Fibonacci will be our Fibonacci. We use it for two things basically. If we want information on retracement, or if we want our targets for our impulses. And how you're supposed to put it is always on the previous leg. So picture this is the market, okay? This is the market. Now if you want information on this retracement, you need to take your Fibonacci on this impulse, because if you want information on this leg, you need to put it on the previous leg. That is the rule. If you want information on one leg, you need to take your Fibonacci on the previous leg. So if now we want information on this retracement, we will take our Fibonacci from this high to the low, and we will have our strong levels of resistance that are the 382, the 50%, 618, and 78.6. Now, when the market will start the next impulse to the downside, basically, if we want information on this impulse, we need to take our Fibonacci on this leg, because now, if the market is impulsing to the downside, this is the previous leg. So basically, from this high to this low. Now, what you're supposed to do, again, if you want information on this impulse, you need to take your Fibonacci from the high to the low. So from this high to the low. And you will have two targets. Target 1, that is the red one, that is the minus 0.272, and we will just call it minus 27. And second target, the minus 618. This will be the second target. So again, I repeat, if we want information on the retracement, you need to take it on the impulse. If you want information on the impulse, you need to put it on the retracement. Very simple concept. Now, the question that's supposed to arise immediately to your mind is, how do we know to which Fibonacci level the market is supposed to stop? Because obviously, if you take your Fibonacci from the high to the low of an impulse, there are many basically areas to which the market could stop. It could stop here, it could stop here, it could stop here, or it could stop here. So how do you know at what level the market is supposed to stop? The simple answer is you don't know if you're just watching a chart like this, but if you have a real chart, then you will know it, because the market loves to test the Fibonacci levels that are aligning better with structure, meaning that we have confluence around those fibs. That is exactly how you're supposed to use them. And we will now be going over some live examples of how basically this concept applies in the market. So, looking at current market price, let's just analyze how you're supposed to take your Fibonacci levels without looking at basically patterns or other kind of things. Just to look how you're supposed to use the Fibonacci, because this is what we're trying to learn in this session. So we see immediately that we have here a very nice impulse to the upside. The market started from this low and went to this high. Obviously, after this very big impulse to the upside, as we have seen before, the market loves to move in waves, so we are expecting a retracement. Now, if we want information on this retracement after the first red candle has basically printed, if we want information on this retracement, we need to take our Fibonacci on the previous leg, so on the impulse, because as we said before, if we want information on the retracement, we need to take our Fibonacci on the impulse. So let's do it. Let's take our Fibonacci from the low to the high, and let's see which Fibonacci level is aligning better with structure, because that is the Fibonacci level that will hold the price. Now, if you look at the 382, okay, look at the 382 level and extend the box to the left. As you can see, it is not hitting the previous resistance, now turns support. And we will be talking about this concept immediately. When you have the market that is in an uptrend, when the market breaks the high, this was the previous resistance, because the market has found resistance around this area. And then when the market will go for a retracement, the previous resistance will become support. And the same thing is when the market is pushing to the downside. The market breaks the low, goes for a retracement, the previous support is now resistance. So this is a very basic concept, but at the same time it's very powerful, because it helps us understand where you have confluence and which is the structure area. So as you can see, the Fibonacci level that is aligning better with structure in this case is the 50%. And if you look closely, that is exactly where the market hit the first time and impulse to the upside, and also the second time and impulse to the upside. Now let's keep going with the next impulse the market gives us, and let's try to find again which is the Fibonacci level that is aligning better with structure. So the next impulse is obviously from this low to this high. The market went in a very impulsive phase, and then after the first red candle, you know where to put your Fibonacci if you want information on the retracement, basically on the impulse leg. So let's do it. Let's take our Fibonacci from this low to this high, and let's see what kind of price action we're getting. Now look at the Fibonacci levels. Is the 32 lining up with anything special? Obviously not. The 50%, again, nothing special. The 61.8 in this case, aka the golden ratio, is lining up very precisely with the previous resistance, now turned support. Let's follow the moves to understand this. The market went down, up, found resistance. This resistance is now support, and that is the reason for which we got this very strong rejection. Again, let's do it. The market made this very nice impulse to the upside, and let's take our Fibonacci from the low to the high to have information on the retracement. Is the 32 lining up with anything special? No. Is the 50% lining up with anything special? No. Is the 61.8 lining up with anything special? No. The only Fibonacci level that is lining up with something special, that is this low, because we basically don't have any kind of structure on this level. The only Fibonacci level that is lining up with something is the 78.6, because it's lining up with this low, which by definition a low is a structure level in the market. So that is the reason for which the market hit the 78.6. And in this case, we also have further confluence because we have also a pattern. But that is something, patterns is something that we will speak about in the next lessons. They are basically in this introduction section that is for understanding all the basics before we can again go to the strategies. So let's keep going with how you're supposed to use your Fibonacci tool. again, you have an impulse to the upside, so take it from the low to the high, look left, and see which Fibonacci level is lining up better with structure. In this case, the 382 is clearly lining up perfectly with the previous resistance, now turn support, and also this was a historical structure level because it was respected also in the past. So again, very strong level in the market. Now let's go to some bearish examples. The market makes this impulse to the downside. What you're supposed to do is obviously to take your Fibonacci from the high to the low and find the Fibonacci level that is lining up better with structure. Now obviously the first fib that you will find is this one here. Why you will find this one here? Because as you can see, in all of this push to the downside, you have this candle here. That is this green candle. I will zoom in so you can see it better. This green candle is obviously a structure level in the market because it's a candle that is not related to the move. And that is something that we will be using. If you have a push to the downside and a candle that is of a different color, so basically a candle that is not related to the move itself, then that is a structure level. And as you can see, the market reacted to it many times. 3 times the market rejected it, but then it broke through it. So your next question is, what is the next Fibonacci level that is lining up better with structure? Is it the 50%? No, you have nothing here. Is it the 61.8? Absolutely yes. Why? Because look, this is a very strong area in the market. You have a structure area here and is lining up perfectly with the 61.8. So obviously here we got a little bit of a fake breakout, but overall once the market broke down back below the level, you got the retest of the level and the market continued to the downside. And that is something that happens very often in the market. If you have a fake breakout of a level, so meaning basically the market closes above the level and then back below, you will get a retest of the level and then the market will continue the push to the downside. And you see that all the time also with trend lines. And I hope you already know what the trend line is. Anyway, we will be speaking about them because I have a very special way to use them. Basically, this applies also to trend lines. So if you have a fake breakout of a trend line, so basically the trend line breaks to the downside and then the next candle closes back above, then the market will retest the trend line and continue to the upside with this fake breakout. And this is something that you see very often in the market, and obviously it applies also to Fibonacci levels. So once you had the fake breakout of the 61.8, so the market closed above here with this green candle, closed back below, went for the retest of the 61.8, and then the market continued the push to the downside. Very much expected from the market. Now keep going with our analysis, basically with our lesson on how you're supposed to use the Fibonacci. Let's go with other examples. The market makes this push to the downside from this high to this low. If we want information on this retracement, we need to take our Fibonacci on the impulse. And the Fibonacci level that is lining up better with structure is obviously the 61.8. This was extremely simple to see. We had support here. Obviously, we have resistance here. Extremely simple to see this. Now, we spoke all this time, and it's now obviously pretty clear how you're supposed to use your Fibonacci for a retracement, about how you're supposed to use the Fibonacci tool for a retracement when you want information on the retracement. So you need to put it on the impulse. But now, let's speak of how you're supposed to use basically the -27 and the -618, because as we said before, if we want information on the impulse, we need to put it on the retracement. So again, let's speak about this. So the basic concept is that you need targets, because when the market makes an impulse, the retracement, and starts the next impulse, you want targets for this retracement, for this new impulse, sorry. You want targets for this new impulse. Target 1 will always be the high, because obviously the high is a resistance level. So the target 1 will always be the high. But you also want the target 1 if the market breaks the high, and a target 2 if the market breaks also the target 1 after breaking the high. So this will basically be a basic target. You just take target at the high. Or you have the first target and the second target. Now, I usually always aim at least to the -27, because as a swing trader, I'm swinging with the trend. So I want to see the market continue making lower lows and lower highs. Now, in this particular case, when you have the weekly time frame, then I will find daily targets. I will find these targets on the daily time frame. But now that we're on the weekly, anyway, let's do this on the weekly just a couple of times, or actually it will be better to do it on the daily. Let's do it on the daily, because on the daily you will have a better understanding of how this concept is supposed to work. Now on the daily, because you basically get more swings, just for that, that is the simple reason, you get more swings. Now for example, let's go with an easy and clear impulse to the downside. You see it very easy from the high to the low. You have a very easy impulse to the downside. You want information on the retracement, you already know it. You take your Fibonacci on the impulse. But if you want information when the market starts the next impulse, where your targets are supposed to be, target 1, you know it, is the low. But the real target 1, so when the market creates a lower low, because I know that the market is in a downtrend basically, I need to take it by using this retracement, because this retracement will give me information on the next impulse. So if I want information on this next impulse, I will simply take my Fibonacci from the high to the low, and I will have target 1 and target 2. Target 1 at the minus 27 and target 2 at the minus 0.618, which is also aligning perfectly with this low here. But anyway, in this case the market exceeded them, but it doesn't matter. You need clear targets when you're analyzing the market. Let's keep going. The market makes a nice impulse to the downside here, creating a lower low. So a low that is lower than this low here. If you want information on the retracement, perfect. You already learned how to do that. But if you now want information on this impulse here, then you will clearly need to take your Fibonacci from this high to this low. And that will give you two targets. It will give you target 1, which is the minus 27. So if you want information on this impulse, again I repeat, you need to take it on this impulse. If you want it, on this retracement. If you want information on this impulse, you need to take your Fibonacci on this retracement, and you will have two targets. Target 1, that is the one that hit this time, and most of the times my take profit will be exactly here. For most strategies, if not all, actually for all strategies, take profit is here at the minus 27 of the previous leg. This is target 1, and then you will have target 2 if you want to hold it longer, but that is just if you have also monthly targets that are lower, then you can extend basically your take profit all the way here. But overall target 1, and it's the reason for which it is in red, will be at the minus 27 of the previous leg, because the first, in this case, support area or resistance area, if it was a push to the upside, that the market will encounter when it starts the new impulse. So keep going in the market. We have again an impulse, retracement, and again an impulse. If you want information on this impulse, you need to take your Fibonacci on the retracement. So taking our Fibonacci from this low to this high, we have two targets. We have the target 1 that is here, and the target 2 that is here. And as you can see, target 1 is exactly where the market stopped when it broke the high. It went here, and then the same candle that touched it retraced all the way, because these levels, as I said, are very strong levels in the market. Now I hope the concept is pretty clear, and I think it is. Anyway, I will go with another example just to clear it up one last time. The market makes an impulse. In this case, we will be summing up both the concepts. The market makes a retracement, makes this basically an impulse to the downside. It opens with a gap. So, and it creates a low, because this low here is lower than this low here. So if you want information on this retracement, you need to take your Fibonacci on the impulse. Let's do it. Let's take your Fibonacci on the impulse. At this point, what we're supposed to do is look at the Fibonacci level that is aligning better with structure. And as you can see, in this case, it is the 50%, basically the zone between the 50% and the 61.8. Because as you can see, this was the previous support. The market was hitting the area and getting rejected, and now this is resistance. So this will be the Fibonacci area between the 50% and the 61.8 that we're interested in. And the market hit the area and pushed back down to the downside. Now when the new impulse to the downside has started, you need to adjust your Fib to this high here, because if before you wanted information on this retracement, now you want information on this impulse. So you need to adjust your Fibonacci in this way, basically from the high here to the high here. And in this way, you will have your two targets, target 1 and target 2. Target 1 at the minus 27 and target 2 here. Very simple concept, and the market hit the targets. This is how you're supposed to use the Fibonacci tool and how we will use it in our strategies, and it's important that it's clear. If it isn't, you have my number, just send me a message and I will help you out.